All right, so we followed up on Monday's weakness with a small little nothing day yesterday and then more weakness today. And so again, going back to Friday's market outlook video, we expected there to be some weakness this week. We know where the support levels are. We talked about that. We got a pretty down day today. So I'm going to break down whether or not today's sell-off alters that thinking that we were already expecting, and with support levels that we already expect us to go down to, or was today's selling worse? Does it set us up for even more than what we expected to the downside? And can things really break down from here? So I'm going to break that down with our technical indicators to see how bad this was, or was it? And while it may be bad for some, especially those that are more bullish than they should be, it shouldn't have been that bad for most. In fact, like I said, in our portfolio, in our class portfolio, we're actually up over 1% today. So, depending upon how you're set up in your active portfolios. So I'm going to break that down, and then we're going to take a look at a trade idea of a stock that is showing its own kind of bearishness with a lack of margin of safety, and we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, October the 28th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line continues down. It has been going down. This whole time we've been light pink shading. Now we have the red line to go with that light pink shading, and we're that close. We're at 55, and getting below 50 gives us a dark pink shading, which we already have on the Dow Jones. So the Dow Jones did break down below 50, obviously below its moving market sentiment line, and we have dark pink shading and a red line. If you take a look, if I add on how far down below that 30-day moving average we are right now. One second, here we go. There we go. Bring this up here, and then let's add on today's value to the 30-day moving average. If I can do this here. Very picky. All right. So here's where we're at. We are currently in the 57th percentile, so relatively low. We've been much lower, obviously, with the, if I zoom out over here, so much lower. But we are at 4%. We are 4% down below, which means we're likely to get to dark pink shading in the red line. So we've fallen that far below the moving average. It's hard to kind of bounce right back right above it when you're down this far. Of course, anything can happen. We have broken through also, here where we broke through the 78% Fibonacci retracement of this decline, but the expectation we go up to new highs. And we talked about that, like most investors would consider that to be very bullish. And there was a lot of bullish breakout signals there. But, again, we weren't really buying that. There was those four gaps in a row, and I just wasn't really buying that bullishness. It was pretty parabolic. I was a little worried about the kind of blow off top nature of that move. I thought there was still some weakness left to come. It needed to hold the breakout, which it didn't. 2 days later it didn't, and we've been below it ever since. We flirted last week with the top of this Fibonacci retracement zone. We got to the middle of it in the last couple of days, and we busted through the rest of it, and then back below the 23% line of the decline, which means that there's a good chance we get lower lows compared to this one here, especially with the intermediate line peaking here without getting into the upper reversal zone. I've talked before about how bearish that is to get a peak on the intermediate line without it being, without the buyers being in control. When you've got the intermediate line above 80, when you're on a good strong trend. You also see, too, the blue dotted line. That is a 23% retracement line level of the rally that we've had. So, because this is the beginning of an intermediate pullback here that got dark pink shading and a red line, and I believe this is a continuation of that intermediate pullback. I don't think we ever really got a new bullish intermediate run coming out of this. And you can see we are back to that 23% line. I've talked before about the expectation that we'll come down to around to this 78% level by the time all is said and done. I still expect that. I expect that I don't think we'll fall off a cliff. This is a relatively bearish move. It is a bigger range, especially when you account for the gap. But keep in mind that, we rallied this much. The moves between 0 and 23%, there's nothing that can really move or stop it up and down. So The fact that we rallied so much here has produced this really wide range between 0 and 23%. So we can get moves to the upside, we can get moves to the downside, we can get moves back to the upside, we can get moves back to the downside. That's just the nature of moving between 0 and 23%. It seems dire on days like today and Monday because it is such a wide range. But remember, it is such a wide range because of this rally, of how big and extended that rally is. So no one ever talks about it. In fact, today we kind of talked about, I heard on TV that they said, why did the market get caught off guard by this rising COVID cases? It seems pretty expected that we were getting rising COVID cases in the fall. And the reality is the market doesn't get caught off guard. What happens is the market buys, it goes up too much. It's just, this is what happens. That's why we pull back, because it comes back down to a level that the market feels better about it. But when it rallies, it typically goes up too much. And that was the case here. And we've pulled back from these highs after these clusters of going up too much. It just corrects. It overextends, overshoots, because greed is a very powerful emotion. It overshoots, and we overshot, and we're pulling back. It's nothing. It's nothing out of the ordinary, and you can see from a volume support standpoint. There's your 23%. The point of control for the 1-year chart is right here, just a little bit below where we're at. There's another strong volume node at that 78% level that can also act as a very strong support. So, there's plenty of support here to suggest that, yeah, we've had some weakness here that we've had before, nothing out of the ordinary, and nothing that would precipitate, a free fall like we saw in March. I think everybody's worried about that type of move, and the expectation is it's unlikely. Unlikely that we'll get that. Now, typically in intermediate pullbacks, there are certain signs that we see. And one of those signs is that we break below the 100% level, or 0% level, on the bandwidth, which means we get below the lower band, which we did here, and that started the intermediate pullback. We didn't in September, and we finally are now. So there's a few others that I'll talk about later in the video, but that was one key sign that we are finally starting this intermediate pullback, right? Well, we actually started it, but now this is kind of cementing it, right? That we're continuing this pullback with the break below 0 on that Bollinger Band. Let's get back to the market forecast. I told you the Dow got the dark pink shading in a red line, kind of what we expect to see on the S&P. The Nasdaq's getting there. You can see the Nasdaq is close to its 23% level. And remember, I do expect it to hit its 38%. So I think that the Nasdaq is working its way down to this 10,250, 275 area. Its intermediate line also breaking down below, and you can see a very bearish near-term high point here. And then finally, the Russell 2000 finally gave us a bearish posture. It's been maintaining bullishness, even with a cluster, an overbought cluster. It now has broken below 80. We finally have light pink shading. We also have a red line. You can see it's at that 78% level of that decline where I think the S&P will get to. I think the Russell will get back down towards the 62% level. That's kind of where I'm watching, and that would break it below the 23% retracement and work its way down to its 38. So in this area is kind of where I expect the Russell to eventually work its way down to once this intermediate decline that started in September finishes here around this November election. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here at the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again tomorrow. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, you can do it with one click right now while you're watching. Also, while you're down there, click comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching our Market Outlook on our website, and you can get there just by clicking on Market Outlook right here. You can see the most up-to-date Market Outlook there. Check out some of these other things on our site, including our Market Outlook live video. So every day I do the Market Outlook. I also do a live video at 3:30 Eastern time. You can get to it by clicking here or mouse over Market Outlook and click on Live Trade Review. That's where I look at all the trades I always do in these videos, and we continue to manage them as part of our my class portfolio actually that I do in my trading rooms, which you also get access to. So all of our subscribers, whether you're a monthly subscriber or a premium subscriber, you get access to those live trade reviews as well as the trading rooms. The Q&A sessions that Brandon does here tomorrow, and then I do mine on Saturdays, those are for our premium subscribers, as well as our premium tools and our access to our communities for our classes where we post, where we have our custom content, and you can be able to interact with other premium subscribers that are also attending those trading rooms. Come down here, this Thinkorswim chart links, the charts that I use and Brandon uses in his videos, they're all available for our premium subscribers as well, and you can get those setups with this post. You can see I'm highlighting here on the right. Click on this heart, opens up a new window. Hit that like button right there. Click on this thumbs up, also opens up a new window, and you can also click on this like button here. So again, the more you do that, the more our posts will be seen by all of our followers because they'll have more engagements. So we appreciate that when you do that. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's get back to the charts. Let's take a look at the weekly chart. As you can see, that's a pretty bearish weekly candle, and that's a pretty long lower shadow, and those tend to happen here. And we would expect the next candle to kind of come into that low end of the range, if not get us a lower low eventually. As you can see on some of these others, you tend to get long lower shadows on the not so high upper shadows on the bullish ones, but you tend to get pretty long lower shadows on the bearish ones because we tend to move down so quickly. And you can also see that we're sitting at the 23% retracement, still above the 200-day moving average, which is actually above that 78% level. So if we do come down to that 78% level, that means we will be breaking the 200-day moving average to get there. And there's a pretty decent chance. I mean, it happens a lot when you after golden crosses to retest and even trade a little bit below the 200-day moving average. So very decent likelihood that that can happen. Now, if we break that, now we're going to be pretty significantly below the 200-day moving average where we could get a death cross. I think that's unlikely. And of course, nothing's, I mean, I could definitely be wrong, and nothing's 100% or 0% in technical analysis. But I think the odds of that are relatively low. There's very decent support in these areas. If you take a look at the market forecast and look at the weekly chart on the market forecast, again, you can see how we're getting down to that 30-day and getting below that, or excuse me, 30-week moving average, and getting below that would also be retesting that 78% level. And very, happens a lot on these after these kind of go when we start these bullish intermediate runs like we did back here with the COVID setup. So very decent chance that that can happen. You can see the near-term line is working its way down. The momentum line is very oversold. We haven't seen this level of being oversold since the COVID low point. Very extreme level, and even over here that was pretty low. So there's a lot of sentiment, bearish sentiment this week. While we might continue down over another week or two, this might be the worst of the selling that we see. If we take a look at the 3 green arrow charts, you can see obviously we have 3 red arrows now, and we're, like I said, we're well below that 30-day moving average, which makes it likely that we'll be bearish here for a little bit. The MACD is crossed below 0. The stochastics is dropped below 40. Those are bearish levels for both these indicators. The moving averages are getting close even to dropping below 0 and dropping below 40. The 8-day is crossed below the 17. That's why the MACD dropped below 0. Big drop in the histogram, so a lot of bearish momentum, but you can see it's about as much as we got over here. So we can still go down with the MACD rally moves up. Just with less momentum. So that's a very decent possibility coming out of this strong move this past few days. But you can also see the 8 and 17 day are working their way. They're still above the 30. And in fact, this we had barely dropped below the 17 on Monday, and it was either bounce up or not. And we didn't expect that we'd bounce up, and we didn't. And now we're well below the 30, and there's expectations of more weakness here, even if it's not to the same extent as today. Right, we might not get another big down. Like this was a pretty sizable decline here, more than 3%. you can see even in September when we got a 3% drop, we didn't follow up with more 3% drops. The drops got smaller. Even with the drop in June, we never did follow it up with significant drops more than 5%. So that's kind of what I expect. The VIX has moved up. The historical volatility is starting to rally. You expect that it will catch up like some of these others did, to the point eventually where the VIX will drop back down below historical volatility. So something like, we don't see it as much over here, but on other intermediate pullbacks over here, you can see when the VIX drops back below historical volatility, then we know we've set the low point. So we'll kind of keep our eyes on that. Let's take a look at some of these other oscillators really quick. The RSI and the CCI dropping below 40, dropping below negative 200. Those are very bearish levels. On the DMI, I mentioned that your intermediate pullbacks really starts when that when we get a strong move higher on the negative index and the positive drops below 20. Well, we got it dropping below 20, but we didn't really get a strong move higher. That's about as high as we got. Well, now we're getting up to 40, and you can see some of these other pullbacks here where you get these strong moves. Even before things really hit the fan, we got a really strong move on the negative index. So that's why, again, I think there's still some opportunity here for some weakness. Again, maybe not to the same extent as today, but following up on today through some ups and downs, right? So I don't expect every day to be a down day. There's going to be up days, maybe even tomorrow, but I do expect that we'll continue the weakness with some more down days as we see all these oscillators are telling us that that's what we should expect. All right, now let's take a look at the intraday chart, and you can see we are down below the value area. That's why one reason why we're so weak here. I mean, there is no volume down here in the last 4 weeks. It's very easy to be bearish. Now, that doesn't mean it has to last. You can see there's a little bit of a bounce here in the after hours to the upside. So just as easy as to go down here, it's just as easy to go back up to this 335 or even up to the gap up to this 332. There's very little volume above us. This little node right here is at 328, so we'd have to kind of clear that node, but once we get to 330, we can move up to 332 just like that, if not up eventually to 335 5-ish to the bottom of that value area. So like I said, when you're bearish, it doesn't mean we have to go down every single day. There's going to be, as you see here on the daily price moves, you can go up, you can go down, you can go back up, you can go down, you can go back up, you can go down, you can go back up, you can go down, you can go back up, up. So it doesn't have to be very bearish every single day. In fact, we've had 3 bearish days here, kind of like this move in early September, and then that was followed by an up day, a pretty decent size up day. So don't be surprised if we don't get a pretty decent size up day tomorrow. But unless it clears, let's see here, go back to the weekly chart. Unless it clears 335 or even like this 340 area, then that's a rally that you would sell up into that spot. So again, with the expectation of continued weakness, even if it's not as strong as what we've seen the last couple of days. If you take a look at today's volume, it was tremendous. It's the first day that we've had more than 1.5 times the average volume. Not as high as what we saw in September though on an absolute basis. So pretty strong volume considering where we've been here lately. Pretty strong move below the moving average, as we've talked about before. And then you look at today's trading range, you look at the close 339.39, the high 338.25. So add another point to that, and we're looking at a 13-point range and a 5-point average. Very strong move. So what that means is you're going to get these start moving higher, right? So the volume kicks us up. We're at 126 today, so that will start to bring the average volume up. The ATR obviously moving up with a strong move. So kind of look, expect to see, 6-point moves, both to the downside and to the upside. Probably not this 13-point moves, but, again, to get 2%, which is, above where this at, and that's pretty bearish, to get 2%, you only need 6.5 points, roughly. So look for more moves like that as we kind of grind our way up and down here and move our way lower, potentially down, like I said, to that 78% level, down in that 315-ish area. So looking at volatility, here's the other sign that we finally got an intermediate pullback, right? The VIX finally jumped up to 105%, which is typical of intermediate pullbacks. We never did get that in September, right? So if you look at September here, we didn't jump. When we first had that big sell-off that brought the VIX up from 25-ish all the way up to a high of 38. We never did jump up to even above the neutral zone, and definitely didn't close there. We only closed one day there at the bottom end of the neutral zone. Well, we've been gradually working our way up into the neutral zone, through it, to the bearish side. And the last couple of days we've been at the 100% mark. Well, today we finally got to the 105% mark, which is typical of intermediate pullbacks to get that high. So now if we get up to 115%, now we're expecting the market sentiment line to fall below 50 as well. It kind of give us a more of a longer term decline. We talked about that possibility in my class today, the options inventory class. So if you want a little bit more discussion on that, on what the target would be to the downside for the S&P, if that were to be the case, I think that's a low probability. But if that is, and then we talked about where support would be, and if you break up to 125%, now we're looking at a potential death cross. And you can see we're not to that point, even with the VIX as high as it is here. Now, last time we got up to 40 in June, we were just at 100%. So this kind of shows that this little pullback is a little bit worse than what we saw in June, because that was an intermediate pullback. We never did close at 105%, and now we are. So we're finally getting signs that we haven't gotten all September that this is indeed an intermediate pullback. And just like I've been talking about, the worst of the pullback may be at the end of it, that we may be seeing here right now as we head down towards that Fibonacci support. All right, so before we look at some other charts and talk about what's driving this action, just to summarize the technical outlook, obviously we're bearish. We're finally getting signs of this intermediate pullback that we didn't get in September. And when we see that, when we don't get the most bearish signs at the beginning of an intermediate pullback, then it's likely that we'll get it at the end. And that's what it seems, which means we may be pretty close to the end. Now, it still might be another week or two away, but in terms of the depth of the pullback, there's a little bit left to get down to that 78% level, and the moves might gradually get smaller as we go through some ups and downs. But this selling, like this week, Monday, and then now today, might have been like the worst of it, and we'll just kind of follow it up with some ups and downs, with more to the downside, obviously. Before we're all done, before this bout of weakness is done. And then after that, remember, there's still long-term tailwinds, very bullish long-term tailwinds going forward, especially if VIX above 40. That is also a pretty decent long-term tailwind for equities. The 6-month and 1-year returns when the VIX are at 40 are really, really good. So we're just adding another piece to the pie of bullishness that we can expect to see going into 2021, and once we get through this election cycle. So what do you think? Do you agree with that, or do you disagree? Comment down below, especially if you disagree, as to why. What are you seeing that either suggests you're a lot more bullish now than I am, or you're a lot more bearish than I am? Share that in the comment section. All right, now let's take a look at what's driving this price action, which you can see on this 3-month chart is pretty broad-based. Like, everything is dropping. Small cap stocks, QQQs. In fact, if you take a look at just how things have been performing here this week, so let's come to October, and we'll start it off on this week, you'll see that it's pretty broad-based. In fact, small cap stocks are actually falling more this week than QQQ names are, which I always show you this chart. Here we go, the relative strength chart of QQQ, and you can see we're down on an intraday basis, but from 1 week to the next, we're actually up. We're up higher. It's not a red candle, and you can see the RSI is still above 50, and while you still have, you have falling momentum here, MACD as well as the PPO, they're still at very, very high levels. In fact, if you go to as far back as we can go, let's come over here. In fact, let's do a little bit bigger of a chart. Let's go landscape and go out to 20 years, just to give you an idea of how bearish that is. Actually, we need to go a little bit further, don't we? There we go. Then you can see, that's still a really high level. Like, all these other peaks that we've had were higher still than those. So it's still very, very strong momentum. And the Qs are still outperforming small caps. So we're not, that's actually a good sign, right? If we were really breaking down hard, like bear market breakdown, then you would see small caps holding up better than the Qs. But that's not been the case. In fact, even emerging markets are holding up really well this week. They're down 3%, but they're holding up much better than U.S. stocks are. The dollar is up today, not surprising. Gold is down as a result, even though it's a safe haven trade. It's down because of the bullishness in the dollar, but it's outperforming equities. So you might think, oh, gold should be up on a day like this. Well, gold is up against stocks. It's just not up against other safe havens, especially the dollar, because when the dollar's bullish, that tends to put some pressure. You can also see bonds were relatively flat, though they're up on the week. If we take a look at how some of these assets are performing here, let's take a look at the market forecast and then look at the euro-US dollar currency pair. It's our proxy for looking at the dollar. And you can see it's turning around too, just like equities. And we talked about that. We didn't buy into that bullishness on the dollar, or on the euro, excuse me, the weakness on the dollar. We didn't buy into that. And now we're getting the renewed strength in the dollar. And I expect that will probably come down towards this 38% Fibonacci retracement, at least by the time this weakness is said and done. It would be a similar move below the September lows that you're seeing in equities. And you can see the rollover on the intermediate line. Again, that's a pretty bearish rollover. It looks like it's the start of a new intermediate run, dark green shading, green line, but then we turn right back around to light pink shading and so far red line, and most likely dark pink shading eventually by the time all is said and done. If you look at TLT, it's bouncing back up again towards a falling moving average, so don't put a lot of stock into that. We're not like bonds. I don't expect to take off here. They're already pretty overbought as it is, but they're not going to take off here. They're just bouncing up from oversold levels themselves, and I highly doubt they'll get to overbought levels again. This isn't a broad-based risk-off move. This is basically just stocks are really bullish, and they haven't had an exhale, and now we're finally getting an exhale because the environment isn't there to sustain and overshoot to the upside, which is what we've currently had. So that's kind of what we're seeing here. And you also see some pressure in commodities too. A little bit of a downside move in crude oil, breaking below that 23%, but most likely, again, like other asset classes, going to work its way down towards support, potentially a little bit below those September lows. Nothing more major than that. So weakness across the board. It's not just in the U.S. Equities. There's all sorts of other asset classes that are also showing the same weakness. And when I look at all the major economies out there in their charts, you can see everything is bad. Look at Germany, look at Italy, look at France, look at UK, and we are pretty light on developed markets in our class portfolio. Tomorrow I teach the portfolio management class. We've been pretty light in developed markets and focus more on emerging markets. And there is, except for Japan here, but China, you can see South Korea holding up really well. India, they're bearish, but they're holding up better than what you're seeing in France and the UK, and where we're getting lockdowns across the board, and even in Russia and Canada and Brazil. This is broad selling. It's not just U.S. It's everywhere. It's just not as much in these kind of three Asian countries. These emerging market, and that's you can kind of see that this is maybe a little COVID related, because those are the three areas right now out of all of these, except for maybe India, that COVID hasn't been hitting as hard. So it kind of shows where the market's focus is. Might not be so much on the election as it is on the disease and the control of that disease. All right, if you take a look at the sector performance here over the last 3 months, again, you can see what had been working: technology, discretionary, industrials are all getting hammered. Communication services as well. Not surprising, they've been the big winners lately. Energy also really struggling. It's been the biggest loser, and it continues to be the biggest loser. If I just go look at just to this week alone again, so let's come back down to October and look at how things are performing here just this week. Again, utilities were a strong performer yesterday when we were on an up day, and I even tweeted out that it's not really the most bullish pattern to utilities leading, but you can see utilities, staples, real estate, they're all down 4%, 3% for utilities. So they're everything goes down when you're weak, but they just don't go down as much. As you can see, the biggest losers, interestingly enough, are not technology, discretionary, and communication services yet. They're kind of matching the market's weakness. But the biggest losers are actually industrials, financials, and materials, and energy, of course. But those three, which have been, kind of everyone's been looking at those, kind of the small cap sectors that, we might be rotating into, with new leadership, especially as these tech names lose their leadership. As we see, that is not the case. And we've talked about that. That is not the case. The leadership will continue to be, even when we go back up here, but when this bout of volatility is over with, the leadership will continue to be in that tech space. Now, they don't have the greatest margin of safety right now, and we've been taking advantage of that, and you'll see that some more of that in today's trade idea. But despite that, once they do fall towards support and hit their support levels, and we start to bounce up as a whole, then I expect that they'll bounce up more, because that's where the market is right now. That's the kind of market we're in and the kind of economy we're in that's leading towards that. And there will come a point in time where that won't be the case anymore, because we're pulling forward a lot of tech spending in those areas. Once that's done, then you'll see something similar to 2000, 2001, 2002, where Y2K pulled forward a lot of tech spending. And once it was done, then there was nothing left to spend. And that will be the case here once we roll out, this finishes work from home space, and we, that becomes more ubiquitous. Working from home, it's easier to do. Companies have spent their way to make it possible, and the 5G has made it possible as well. And once we get that rollout done, then the spending will be not as necessary anymore, and then you probably won't see technology be the biggest sector in the S&P, just like after 2000, right? You'll get a new leadership. What that will be, who knows? It was financials last time, and I don't know what it'll be this time. There's a good chance something like industrials could be there again, since it's been so weak for so long. Industrials or financials might make a run with yields working their way back up towards that 2, 3, 4%, 5% levels like we were in the past. All right, so that brings us to our trade idea of the day, and I want to take a look at Adobe. Adobe, as you can see, is giving us a bearish market forecast pattern for the first time with a break below its 23% retracement level of this rally. Dark pink shading and a red line. See, we never did get that in September, and now we are. So, and we're getting the intermediate line dropping to its lowest level, dropping below 40 to its lowest level during this decline. Never did really significantly drop below 40 here in September. And you can see short-term sentiment, the near-term line has been below 50 for this entire time, which is also pretty bearish as well. When you look at its 3 red arrows, obviously it has 3 red arrows, and you can see, it's like I mentioned before, like the MACD's moving average hadn't crossed below 0 on the S&P. It has on Adobe. It has dropped below 40 on Adobe, where it's closer on the market. So you can see we had broken below the 17-day. We never did get back above it. Now the 8 and the 17-day are both falling below as we extend away from the 8-day. These are all bearish signs. Of course, when you look at some of these other oscillators, you see they're bearish indicators as well. But almost negative 200 on the CCI, below 40 on the RSI. You look at the DMI, you can see that we are getting above 30, below 20 on the positive, above 30 on the negative. Rising ADX suggesting increasing bearishness. You look at the Ichimoku trend cloud, and you can see that we are breaking through to the lower end of the cloud. That's very bearish, with now at least a weak bearish posture there, a trend that we haven't had, right? We haven't had this is the last time we've been any kind of bearish at all on the stock. And then you look at the Bollinger Band and say, okay, well, there's some pretty decent volume here, but we just went through that much in the last week, so that's not enough, and that's even less than what we've gone through. And then there's nothing below that, so we can get to the 38% relatively easily, if not below that, into that gap. And so what I did was I did a relatively high probability bear put spread again. I sold the 430 put and bought the 435. Remember, that 38% Fibonacci retracement is right there at 430. So that gives me about a 3-to-1 reward to risk ratio, pretty close. But what it does, so if we drop down, you can see it's dropped down since the Market Outlook Live, right? We put this on during the Market Outlook Live video, and the stock continued to move lower, and that's how much we're already up. So again, it pays to kind of watch the Market Outlook Live videos, because we put on these trade ideas before the market closes. So it's continuing to move lower, and we'll see what ends up happening tomorrow or as we continue on. But you can see the max gain is easily in 1 standard deviation. And even though I'm position size around a half of my normal position, it's going to be very easy to keep it even less than that. So when you got this kind of high probability setup here, where instead of having that max gain way over here, where I'm close, where I really need to start dropping to keep it there, it's well inside. So it can go up and still keep that maximum gain inside of 1 standard deviation. So what that does is allows me to have a really good chance of getting out with half of this loss, around 250. So now $1,500 max gain for $250 max loss is a really good reward to risk ratio. And that's kind of what we're setting up here. Again, buying the 435 put, which is well out of the money. We're trading right now at 458. But selling the 430 put to cover some of the costs. It keeps my costs to a really cheap level and gives me a good return to risk ratio by November expiration, which is only 3 weeks away this Friday. So it's an opportunity to make a pretty decent reward to risk ratio in a relatively short amount of time. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums, and you can post any new threads there or reply to anybody else's thread. And let's keep this conversation going. What did you get out of this video? What questions do you have? And let's talk to each other about what's going on and what you expect. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as on Twitter and Facebook, and also comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.